This we've got the regional versus metro, where to buy in 2025. So the usual, this is general advice. Please seek legal and financial advice before making any decisions. We do not guarantee the completeness or accuracy. The dream team, Isa and Sally, Win and Ron. And this is basically the divisions of Key Choice and 80 Metrics Property Investment Negotiation Solutions, which are both divisions under the Key Choice Group. So Key Choice Boutique Broker of the Year 2024, finalist 2025, 80 Metrics Property Investment Negotiation Solutions. We're doing a lot in the property investment space and vendor advocacy space. So what do we mean by metro? Remember the word metrosexual? That's what those men on the right are. But anyway, metros just means capital cities. So we've got them there listed. I'm sure you know what the capital cities of Australia are. And regional, it's anything outside those capital cities. And there was once a big disparity between investing in metro. You never invested regionally or outside the capital cities. But I think you'll see that that's changing. So difference between the two. Regional's obviously less expensive, 30 to 50% cheaper. There's 5 to 8% rental yields, fantastic. High potential, but there's some volatility in the small town. So we're bracketing regional in anywhere outside the capital cities, but there's regional and there's regional. So we have some criteria around how populous and the proximity to the major town or hubs are, but we're talking about major regional areas with 20,000 or more people. Regional can have slower resale time and some heavy industry dependence, but the government's making changes in that area because of the undersupply and unaffordability of housing to make hubs around the country where the people can access affordable living. And of course, as a property investor, that makes great sense to invest in those areas where there's demand for rent. Metropolitan, more expensive, lower average yield. So when we're seeing 5 to 8% in regional, we're seeing sort of high twos in really high-end suburbs to 4.5%, 5%. Not too bad when you consider the interest rates are in the fives and they're coming down. So there's not huge out of pockets at the moment, but you need to factor in averages rather than times like now where interest rates are getting towards some again historic lows. Historically more stable in metropolitan, more people, there's more demand, less supply. So metropolitan areas have been more popular, faster resale, again higher demand, less available stock, and stronger economic diversity. But again, that's changing. So what's actually happening is, so there's a regional migration. So 35.6% more people are moving from the cities to regions and vice versa. Regional areas have outperformed the capitals for a significant period of time. So, and especially over the last 12 months, and we're taking Australia-wide averages here. So we're not focusing just at the moment on states, and the 5-year disparity between regional areas have seen stronger growth. So some areas like WA and South Australia and Brisbane, the regional areas have been exceptional in their performance compared to Melbourne and Sydney have had less growth, but you'll see that's about to change. And currently quarter performance. So what we're seeing is, instead of dependence on metropolitan areas, capital cities, and then some offshoot of some growth, some spillover into regional areas, they're more becoming independent in their own way and having growth backed by the numbers of people who are moving to the area. So in essence, we still come back to the basics, the four sort of major pillars of the metrics around what are the essential, well, price and yield. People are investing in regional areas because essentially it's been unaffordable to buy multiple properties in metropolitan Melbourne for a number of people. And that has also been because yields aren't quite as good. Property prices are huge. And when you're getting finance, there's a uh, roughly 3% buffer in the back end on your finance. So you may think, well, I've got essentially 5,000 in outgoings per month on this mortgage. I'm getting roughly 5,000 in income. I can afford it, but you've got to understand in the background to get finance on these things. And the banks are saying, well, actually, what if rates go up? We can't have you being in hardship immediately. So we're going to put a buffer on. So mate, we're factoring in the cost maybe 6,500 a month, do you? Even though it's 5,000 at the moment. On the flip side, with rents, years ago they used to only factor in 60% of your rent in case of vacancies. Now it's up to 80 and sometimes 90, and that's really changing because of the pressure on properties. The vacancy rates we're seeing are under 0.5% in a lot of areas. In the areas that we look at, it's definitely under 2%. So there's a huge stress on being able to get a rental property, even though the cost of renting is being exorbitant. People have to live somewhere. So if we're talking about borrowing capacity, the banks take in 80% of the value of your rent. So we've gone from, well, 5,000 going out, 5,000 coming in. Well, the bank's saying, well, 6,500 going out, and we're going to say 4,000 coming in. So that's why you might think you can afford it, but you definitely need to speak to eyes about your borrowing capacity. Other fundamentals, so just basically, can people afford to buy in the area, and how much disposable income is coming in? That indicates what can be paid for property. So you want an area where people have disposable income and are able to negotiate and buy your investment when you come to sell. How many units to houses? How many renters to owners, and supply and demand? That's the essence of all economics that we're looking at. So I just wanted to run you through. We've gone metro, we've gone regional. Let's take a step back and have a look at what is actually going on in Australia at the moment. So we've got a number of slides, and they're all color coded for simplicity for people like me. But essentially, the darker areas on this map have poorer cash flow, and the lighter areas have greater cash flow. So a lot of the mining areas you can see have better cash flow. So if we go on these maps, the yellow is over 5% in cash flow. So rental returns. So you can see there's areas of Tassie. The lighter, the better. So over 5%. This orange is between 4.5% and 5%. A little bit darker is around 4%. So you can see there's areas in and around, and especially in regional Queensland, that have really good cash flow. But surprisingly, getting in closer to some of the major cities, this cash flow is reasonably good. It's not the entire picture, but it's not saying we're not saying that the cost to hold these properties is exorbitant. So you're only going to be able to get one, or you're going to be under some pressure to supply the cash flow to maintain the property until you get a payoff in capital growth. It's not the facts of what's happening. Yields taking into account just a general return based on some expenses, how much you might contribute to a property, etc. It's essentially the same color coding, but we're in a time where there's neutrally geared properties really right around Australia. It's quite quite an unusual time. That's because the interest rate environment's there, that's coming down. and the pressure on rents. Again, I was saying half a percent of vacancy availability. I mean, you've got a huge amount of demand for properties. We're speaking to some agents up north yesterday, and they are expecting that a property we were looking to get $1,300 a week rent. Could be up to 2,000 a week by the end of the year because they just do not have stock. And yeah, the pressure on those properties are huge. URSAD, so these things all combine together. So URSAD is the ability to pay, essentially, the percentage of income being used for the mortgage. Again, the darker areas mean that those areas are the more challenged, the greater the percentage of income being used to pay the mortgage. So some of these areas where we're starting to see, we'll go back, we'll say, well, there's some areas here that have got good cash flow, good yield, and they're actually a smaller percentage of their income is being used for to pay the mortgage. Days on market, we're seeing a similar pattern. And so the days on market, the lighter the color, the shorter time they are on the market. So the increasing demand. So we're seeing, and these color patterns change. So 6 months ago, they were in Western Australia and North Queensland were really light, meaning that there was very little stock, there was great cash flow, there was great yields, there was the URSAD takes a lot longer to change because that's the demographics of an area, but that happens with gentrification. So stock on market, again, the lighter, the less stock. So we're seeing a pattern here. Some parts of Queensland really light stock on market. That means that they're not staying, they're coming down from 60 days on market to under 30. Some of the yellow areas there, 12, under 2 weeks on market. So what's coming on is being immediately snapped up. The darker areas are areas where the stock is on the market for longer. So again, we're getting a picture. Yields are good in some areas. Stock on market is low. Capital growth, it's mimicking. So this is what we're seeing is, again, some areas of southeast Queensland around the Gold Coast, some areas of New South Wales and Victoria is lighting up. So our data is telling us that these are the areas that are going to experience some significant capital growth over the next few years. Lower risk, again, a lot of factors that go into risk, but really the employment, the availability of stocks being low, the high demand for your properties, the vacancy rates, the amount of income that can be used towards paying your rent if you're an investor, all contributes to the amount of risk. Conversely, if you've got an area where there's high stock on market, there's a lot of choice for renters. They're really tight on funds, unable to pay the mortgage sometimes, or it's a big percentage of their income that indicates higher risk. So yeah, so we've talked about this stuff where more people are moving from regionals to capitals. The growth is better in regional than capitals, and then we've got to come to understand now, well, what does it actually mean? Well, the government's saying they're creating these hubs. They've got areas where they've got fast rail, areas like Geelong and Ballarat in Victoria, Toowoomba. They're trying to decentralize areas so people can work from these regional areas. The disparity between metropolitan and regional has leveled out. people are flooding to getting areas where they can actually get into the property market. So no longer is it metro, and if you can't, you just get into regional. There's signs there that there's growth and yield and sustainability in those areas. It's not about um, where should I buy so much regional or metro. It's about what is your goal. So oftentimes people say, well, we want an investment property, but why do you want that? How many properties do you want? What are you trying to achieve? And then and it can also be down to lifestyle. So you might have a risk profile where, look, you've got a long working career ahead of you. Uh, you're now getting the highest income you possibly will during your career and high disposable income. Let's talk about capital growth. Let's take on some of those risk factors. Let's buy inside in the metropolitan area. Or you might be starting a family and you've got maternity leave and other considerations. So you want the stock to be really tightly held. You want no vacancy. You want some growth drivers. So we look back at those heat maps and we understand, well, some of these areas, the demand is high, the supply and building approvals are low, and it's affordable. So that might be a starting point for you. We have four essential metrics, but of course 80 under that. So it's to understand what works for you. It's about understanding where you're trying to get to. The final thing I'll say on regional versus metropolitan is the thing that can open up supply and is happening with the way the government is handling some of the building approvals now is we've got risk in regional areas that there can be open up of land subdivisions. We've got the data behind that to see how many houses are approved in an area, so we can see if you're going to buy in an area and there's been a huge spike in building approvals, well, that can inhibit more supply, the demand for your property. But conversely, there's high density approvals being signed off because of the latent and continued undersupply of property in metropolitan Melbourne. So just because you're buying in metropolitan Melbourne doesn't mean that there's not going to be a flood of stock. Now, of course, the house versus apartments are a completely different conversation, and we try and buy the best value property we can, ideally a home. But the supply demand metrics are still there. Overall, it's very difficult to buy a poor investment property at the moment just because of the demand. But there's a big difference between it being okay and long-term terrific. And how do you mitigate the risk? Well, you buy in those areas that the demand's about to spike. Why I've got sheep here is everyone is talking about Western Australia, South Australia, and Queensland. That's what, if you read all the articles online, if you're sheep, if you follow, that's what it go and do. You're still going to get some good growth and some incredible yields. Me, I'd be buying New South Wales, Victoria, definitely. There's incredible value. You can negotiate hard. You want to buy in a warm spot before it comes to a hot spot. So I think over the next 3 years, there's just incredible opportunity. New South Wales, Victoria. Where? Well, I'm not going to give you that answer because we need to understand your personalised circumstances. I hope this has been informative. It's more at a high level. It's not specific going by in this suburb. We're going to have more of that next week. But it's understanding that the disparity between regional and metro is virtually non-existent when we're talking about major regional areas and the government's drive to build infrastructure in those areas. Hope it's been helpful. Do we have any questions?